Thank you, Uzi. Thank you so much for coming. I know it's a very difficult time, and but I appreciate it very much. We have been in business 20 years in the real estate business, and so we bring a lot to what I'm about to tell you, and I'll go over that in a moment. But why am I here? Why am I in Israel at all? My son made Aliyah during the Second Lebanon War and served in the army in Totchanim, and so I needed a reason to keep coming to Israel, really, Emmett. So I started meeting with people, and I started developing investors here, and made a family with everyone who invests with us, and that's why it was very easy for me to come here even during this time, because I am with family. So I appreciate you coming out for us tonight. Our company, let me tell you about me. I founded our company in 1994. We have 42 employees now above the property level. We don't manage ourselves, so these are all construction people, analysts, asset managers, lawyers, marketing people, and accountants. So we have a really robust platform. We have done lots of things. So we have been a bankruptcy advisor to Lehman Brothers in the bankruptcy in America, and that's one of the things that 2008 to just this March, we finished our last deal working out of the bankruptcy for Lehman Brothers. So one of the things I'll tell you is that in 2006, we saw that the real estate market was very frothy. I mean, it was things would cost too much, and at the same time, operating results were going down, and prices were going up, and it didn't make any sense to us. So we sold everything we owned at the high, and then went into what we call the workout business, solving problems for the financial collapse that we expected to happen. And we did that in 2006. Nobody called us in 2006. Everyone laughed at us. But starting in second half of 2007, we became very busy. And our busiest years were 2008, when Lehman went bankrupt, and 2009. So our company was sort of ahead of everything that happened. And that's what kept us in business and fully staffed during the time when many of our fellow businessmen in real estate went bankrupt or went out of business or lost their properties. So we didn't have that problem. I've also been the co-chair of the real estate committee for the New York Law School. I'm an attorney, and I help run their real estate. I built a $185 million building for them, which we also opened, I think, in about 2008. And I'm, for 10 years, was the chairman of the board of Kennesaw State University, which is now a 35,000 student university in Atlanta, Georgia. And I was the chairman of the board for 10 years, and I just stepped down about a year and a half ago. And when I started, it had 11,000 students, and when I ended, it had 35,000 students. So we had a lot of growth, a lot of buildings were built, and I was in charge of all that. But let's talk about real estate and Radco. So this is the first deal that I did. It's in Atlanta, Georgia. It's a little blurry, but it's the Four Seasons Hotel, office and condominium tower in Atlanta. It's 53 stories tall, and it was the biggest deal in Atlanta at the time. And I bought it out of bankruptcy in Sweden. And so it was our first deal. And why that's important is that that's all we do. We try to find real estate that's not performing as well as the rest of the market. And so we look for these kind of strange situations so that we can make money for ourselves and our investors. But we bought this out of bankruptcy in Sweden. Interesting that the Swedish bank failed. The Swedish government took it over. They hired a Holocaust survivor in New York who grew up in Sweden after he escaped Nazi Germany. And so he spoke Swedish, so they hired him. And we hit it off. And in Yiddish, we actually made the deal to buy this building. When we went to finance it, I was a young man. I didn't have $50 million. And Lehman Brothers came and financed the deal for me. I found out later that I had loan number 1. So I was the first loan Lehman ever made. And so a lot of people blame me. They got excited from the money they made that they went into real estate because of me. And hence that's why Lehman Brothers failed 20 years later. But that's giving me too much credit. And then when I sold it to Blackstone, which is one of the biggest investment firms in the world, if not the biggest. And it was their first acquisition in real estate back in 1997. So a lot of firsts, and it affects what we did going forward. These are some of the deals that we did in the last cycle in the bankruptcy of Lehman Brothers. A 33-story building in San Diego, a golf course, beach club community with 1,000 different homes in Naples, Florida, and 1,279-unit condominium conversion in Los Angeles. So we did a lot of different things like that. I could have 10 slides to show you all the things we did in the bankruptcy. But we worked all over the country with all different types of assets. But right now, we're here to talk about apartments, multifamily. And that's what we're buying right now, and we've been very successful at it. We have 7,000 apartment units right now, 7,000 in America. We should have maybe 10,000 in the next few months. And there's a difference, and one of the issues, it's a cultural difference between America and Israel about what is an apartment. Because everyone here thinks of an apartment that you buy one apartment or 2 apartments in a building and rent it out so that you actually own the unit. But that doesn't happen that way in America. You actually own the entire building and lease it out. We do not sell it to 30 or 40 investors who buy up 1 or 2 or 3 units and they rent them out themselves. We actually own the whole building. We manage the whole building. We control everything that happens. So you don't have issues like here where owners disagree. If I'm on the first floor, why should I pay to renovate the elevator because I'm not using it? So we don't have any of those issues in multifamily in America because there's one owner, one decision maker, and therefore we can fix problems and do things right away without having to negotiate with 50 different people, especially 50 different Jews. I don't know how we get to agree with 2, but 50 is very hard. So we try not to do that. So if you ever invest with us or someone else, people sometimes ask, where's my deed? I want my deed. Okay, so there is no deed. There's one deed for the company, and then you own stock in that company like you'd own stock on the stock market. And so you get a stock certificate. You don't get a deed. So these are the differences. It's very important to know between...
The difference with REIT companies?
Pardon me?
REIT companies.
REIT? REIT. So a REIT, it's like a REIT, but this is private. So it's the only... there's no SEC, there's no government regulations. It's really a relationship between me and you or whoever is the developer of that deal. But it's like a REIT in that way. So that's the difference. It's very important. Now, why is multifamily really good investment, or we think, in America today? And one reason is that in 2004 and 5, during the last cycle, 70% of every American owned their own home. 70%. Today, it's 64%. and they expect it to go to 62%. Now that 8% is 20 million people. 20 million people that are not owning a home and move to apartments. So we have that many more people renting. The whole psychology of American real estate has changed. People don't want to buy a home. Most people can't afford it. They can't put down the down payment. They used to be able to get 100% financing. Now, like in Israel, you have to put a big down payment down, and they don't have the money. So there are a lot of reasons why it's changed, but it's a really dramatic change in how real estate is working. And another thing that's happening is that people are scared, so they're young people are staying in their homes with their parents and renting, staying in their room and saving up money. And now there are millions of young people in their 20s that have not left their home yet, but 10 years ago they would have moved out already. So we think there's going to be a whole shift of these young people. We call them millennials, that are going to be going into apartments as soon as the job market gets better. And it's getting better. So that's why we think rentals are very, very good. Another reason we like multifamily is that lenders like it. So it's very easy now to get a loan on an apartment. It's much harder to get one on an office building or on a retail shopping center. It's much easier to get a loan on multifamily. One reason is that the American government subsidizes lenders who invest in multifamily. So we can get very cheap debt that helps us make money. So that's another reason that we like it. And another reason that we like it is that we think the economy is going to improve. We see it now in many of our markets. And there are jobs being created. Those jobs are generally more workforce jobs. We call it blue-collar jobs. So distribution centers, clerks, truck drivers, manufacturing. And these are people making $40,000 a year, and they're looking for a nice, safe, clean place to live. And so we try to provide that for them. So we see that happening, and we're betting that the economy will improve. It's been 6 years, 7 years, so we think the time is right now. Also, because of Lehman Brothers, no one built new apartments from 2009 to like a year ago. There was no new supply. So no one was building. So you have all these millions of people we just talked about who left their homes and are renting, but there's no new apartments. And we'll see in a minute that occupancies have gone up and everything is full. So we're going to see that. So we like that a lot. And now the new stuff that they're building, the new apartments, are very expensive. So they're building for people making $100,000 a year or more, but the jobs that are being created are for $40,000. So no one's building, just like you have here, no one's building affordable housing. So we're buying up as much affordable housing, older apartments that we're fixing up, but because we have it, bought it cheap, we can rent it cheap. And so all the people that are working are coming to our apartments, and there's no new supply of those affordable housing units. Same problem you have in Israel. So that's why we are focusing on that. And this just explains the three different types of apartments. Class A is brand new. I just discussed that. It could be a high-rise, it could be low-rise, but they're, have Caesar stone and stainless appliances and wood floors and high ceilings, and it's so schmaltzy. So all the kids like to live in the schmaltzy stuff. So that's the new apartments, but they're very expensive. So for example, in Atlanta, that would cost about $2 or more a foot. But if we go to the older product, it may be 60 or 70 cents a foot. So it could be less than half the cost. So that's why we like that B and C space for us. Class B is very, very nice apartments, but they're older. And just because they're older, less institutions buy them, and so you can get good rent on them. They're still very nice, but they're older. So we like to buy Class B because people who are moving up in the job market can afford there. People who want to save money from the Class A can move there. So we love the Class B space. It's our favorite. Class C is older still, maybe from the 70s or the 60s, if it's well maintained, but it may be not modern. It may be obsolete. The kitchens are tiny, the bathrooms are tiny. Some don't have washer dryers. They may have one bathroom for 3 bedrooms instead of 2 or 3 bathrooms, which is typical now in a modern apartment in America. So those are the difference between them, and we'll talk about them going forward. So here's something that's really very, very interesting. Since we've been buying apartments, these are the rent increases nationally. So different cities have different, do a little differently. But nationally, all the apartments, A, B, or C, have gone up since 2012. So for the last now 3 years, the rent's gone up. And a lot of people were saying, gee, with the new supply people are starting to build, rent prices will go down. And they were citing this. Now, they weren't going down. It just wasn't going up as much. It's going up 2%. But if you see since then, it's going up very fast. So that's what we're seeing in all our apartments, that actually that rents continue to go up. Even when it's here, it's actually still going up. It's just going up a little less. It was only for a short period, I think when there was sort of a second recession that hit for a few months, that rents didn't go up as much as they were going up. But as you can see, the trend is very, very, very good. And especially in the B and C space, you see that the rents are going up very nicely. And then we talked about occupancy. So right now, as of last month, occupancy was 95%. That's considered full in America. Why? Because people move out, you got to fix up the apartment, you got to put an ad in to rent it. So just that natural turnover, 95% is considered full. Many of our apartments are actually 97 and 98%, which usually means we're not charging enough rent. So we'll talk about that. But you can see at the low point was 2009 in the recession was like 91.5%. Now it's 95%. That's a very big increase in our business because that's all profit. That's all profit. There's no additional expense for those people paying rent.
What's wrong with February?
February?
Yes, usually February I see the...
Yeah. So the season in America, the spring and the summer, are always the strongest leasing seasons. A very good question. Very astute. So you see that it's the same every year. So it's usually about March to like October is the strong leasing season. That's when between school, so people don't have to worry about the kids going out of one school and going to another, or you graduated college, so you got a job in May, right? So you left college in May, you go and get a job, so now you can go rent an apartment. So usually it's those late spring and summer months when people move. And so that's when the biggest increase in occupancy occurs. This happens every year.
This is Atlanta?
No, national.
Georgia?
No, national.
All over the world.
All over, yeah. Our company is in 6 cities across America now.
This is the occupancy for multifamily for all over the United States.
The average of the entire country. This is kind of strange to see. This is an issue I wanted to just discuss. You may have read, now that rents are going up, developers notice, right? So they are going to build new apartments. So for the first time in 6, 7 years, there are a lot of apartments being built to meet the demand. So there's some concern, will that cause too much supply and the rents will go down or the occupancies will go down? So as I mentioned before, everything being built is luxury. And so I'm not worried about that market. But if you were worried about that market, this is the number of new renters. Remember we talked about people leaving homes to rent, people staying at home with their parents and then going to move out, the millennials. This is the number of new renters per year, right? And you see it's 23,000. This is done in the thousands, so that's, and then, but the supply is only 20,000. So it's still, there are more people coming into the housing market, just like in Israel, than the capacity to build more apartments. So we like that also. So as I mentioned, we look for B and C properties that, and I want to tell you just what kind of properties we do. This is what a B property would look like. Not too bad, right? Very nice. Nice landscaping. It's nice buildings, just older. We look for a story. We like with the Four Seasons, a bankruptcy in Sweden. The bank fails. The government takes over. They hire a landsman from Sweden, and then I get to talk Yiddish with them, and we make a deal. So that's the kind of story I like to hear. We're selling right now. We're buying right now 2 properties in Atlanta. We're buying from the United States government, from Fannie Mae. They foreclosed on them, and then the government, the United States government, seized Fannie Mae, so the United States government is now the owner of the properties. If you see the government in Israel, how well they manage things, so the U.S. government is bigger and they can do it worse. So we look for that opportunity that I just have to be so-so, kacha, to do better than them. So we look for that kind of story. Or we look where the owner doesn't understand. He's an absentee owner. He doesn't understand that the rents went up all around him. He's charging too little. So we buy it on the market price, but it's based on the cash flow that's way too low. And so we immediately try to fix it up.
Which part of Atlanta are you now considering these properties?
Which part?
Which part of Atlanta?
It's a place called Smyrna. It's just outside. Yeah. Do you know that? So that's, we look for that kind of deal. We also look to go where money isn't. So, even in Tel Aviv, there are areas that nobody's building yet. I would go there first. If no one is there, I want to be there and be ahead of where I think development is coming. So that's what we look for as well. Just to show you, this is like what an old kitchen would look like. This wood trim, formica, and what have you. And then this is the similar type of kitchen that after we renovate it, we put down vinyl hardwood floors that look really great, granite. We put new doors on the kitchen, new fixtures. It looks really good. Here are just some other examples of the after. So we put in a little schmaltz, and we get a very good return on that investment. Here's the actual kitchen before and after. You can just see the difference. This is what we did to an exterior of a building. That's the build before. This is after. We put new concrete. It's called hardy plank. It's a concrete material that's shaped any way you want. We put new windows in, and it looks brand new compared to an old 1965 building. It now looks like a 2014 building. And we're getting big rent. You see new balconies from wood. We went to vinyl, and it looks really great. Here's a building that we did a gut renovation. It was empty. It was abandoned. And then this is what it looks like afterwards. And we're getting a huge increase. Here's a pool. You see how the deck is falling apart. And if you look at all these apartments, The glass was broken. The air conditioners were stolen. There were chickens running around, just running around, and roosters all throughout the property. And then we redid it, and this is what it looks like today. And it's totally full, and it's doing very, very well. We changed the signage. We try to remarket the property. Here's a sign before, and then this is the same sign. And then we changed the name and put a beautiful sign in landscaping. You can see the difference. So these are the kind of things we do to add value to what the older buildings that we buy. Another difference in a sign there. So when we buy, the problems, there are always risks, and when we buy. So one of the things when you deal with people who don't make as much money is sometimes they can't pay. So you have a problem, it's called delinquency or bad debt. So you have to deal with that, train your tenants. You have to make sure that you get people who have good credit and that you lower the risk that they won't pay. But it's an issue that we deal with every day. We have to manage the properties a little bit more because lower paying people, generally lower wage earners, maybe have more kids. So they'll run around and need to be supervised. They may make the place dirty. So we have to be much more aggressive in how we manage. We may have to have kids programs to keep the kids occupied, and which is not typical in the States. So we do that so that the kids don't go around horsing around and making mischief. They actually do something fun and creative and learn. So we try to do that as well. We usually buy properties where the seller ran out of money. So they had no money, so no one put money in the properties for a while. So things were run down, the air conditioners are old or broken, and a lot of things have to be repaired. So our maintenance costs are higher. So we have to be careful about that, and we put in capital to repair and upgrade these old problems. So we make sure that we have the capital to do that, and that's an opportunity for us. We have to be great at what we do, because when you're changing a property, if you bought a property in Ramat Aviv, it's a gorgeous building, right? Brand new and it's beautiful. There's nothing to do. Everything works. The people are wealthy. They take care of everything, right? And so it's very easy. But when you're buying a property that has problems, a property that is older, a property where there may be too many kids, you have to do a good job. You have to do it quickly, or else you can lose some money. So you have to be much better at managing than if you bought a brand new property with all wealthy people in it. So something that we have to be ready for, and we have to be ready to change with the market. So we're very sensitive. If there are more jobs and more people want to move in, we can charge more rent, we can give more services, and we have to always be thinking about that. So, and we do. And finally, we as a company have experienced 20 years. This is all we do. So for 20 years we do this, and we think we do it well. I want to show you a couple of examples of properties that actually Israelis are, Uzi has been involved with us on. One is Jackson's Creek. We bought last August. So it's 11 months. And when we bought it, I wish I had a laser. When we bought it, you can see the revenue was $360,000 a month. And now, 10 months later, it's gone up to $420,000.
You have a laser on it.
I do? Yeah. Where? Which one? This one? This one? There we go. Okay, got it. I'm glad I got that at the end. All right, so you see here we're at $360,000. We bought this from a bank in Sweden, another Swedish bank. And it was full when we bought it. It was full. It was 640 units, 640 apartments. It's like a city. And, but the rent total was 360. In 10 months, in June, we collected over 420,000. So we improved, in the same occupancy, we improved the rent 60,000 a month. That's 720,000 a year. And we raised $8 million. So that's 9% cash return higher than when we bought it.
Do you renovate while people are living in?
Yes. Yes. Yes and no. We renovate the whole place, and then we renovate each unit when people move out. And then when people renew, the lease is up, they come to us and say, we like the new appliances. We want a new refrigerator. We want all the things you just saw. And we say, fine, each one has a cost. This is $25 more. This is $10 more, $20. And they have a menu, and they can pick, and we'll renovate it while they're living there if they want. But
what were the costs of renovations?
in this case, it's about $5,000 a unit for the full amount. But the rent increases we've gotten have been about $90. So it's about a 22% return on that $5,000 per year. 22% per year. So we'll do that every day, right? So we'll do that every day. But this is going straight up, and we'll continue to see this, I think, go to 450, 460, 470 in the next 6 months. It's a tremendous investment. But the idea is that we bought it from a bank. They didn't know what they were doing, and all we did was just start raising the rents, getting better tenants in there, making it nicer and prettier without spending too much money. Just enough to show that we care and to make it livable and a nice place for families. So there's one example. The next month, and Uzi is in this with us as well, we bought a 1,000-unit deal. Also, these are both in Atlanta, a 1,000-unit deal, and we have 1 or 2 months that goes up and down a little bit, but overall, our rents are, we've gone from about $340,000 to almost $700,000 since mid-September. So in just, 8, 9 months, we've really increased the revenue tremendously, and it's going to keep going up. Again, I just want to show you what happens when you buy from a bank. In fact, we bought this from Fannie Mae, which is owned by the U.S. government. So it's just like the ones we're about to do, this is what happens. Just a little summary about what we do. So when we started buying apartments in 2011, we had one story. We were buying low, and we were going to sell high. I like that story. And that was a great story. But today, other people figured that out too, right? So prices have gone up a lot. So it's not just buying low and selling high. You have to buy smart, and you have to be able to execute. You have to be really good at what you do. In 2011, anyone could have bought and made money by accident. But today, you have to work it a little bit more. In May, at the end of May, so about 6 weeks ago, Blackstone, remember we talked about Blackstone that bought the Four Seasons from me in 1997, they just announced they're going into my business. They're going to go into the C and B class apartments, and they're putting in $7 billion of equity to do that, which means that they'll probably it'll be what, about $50 billion of apartments that they're going to buy. And to give you an example, we own $500 million. So they're going to buy 120 of me. And so when they go in, all of Wall Street's going to start following. So the money is starting to come into the sector. So we're trying to buy as much as we can now before they sort of take us out of business, which would be very good, by the way. But we want to buy as much so we can sell to them later. So very exciting that they've recognized what we're doing now in 2014. It'll take them a year to get going. They have to buy a platform. They got to figure out how to buy things. It's going to take them a long time, but they're going to be in our business. But we're still able today to buy low. We're still buying low. We have a good reputation. We get to buy before somebody else, and we're still buying low. Not as low as before, but still low. And because we're pretty good at what we do, we are able to get higher revenue, as you saw, and then we'll sell it to the Blackstones next year. We're getting cheap debt, right? So our debt, we talked about the government subsidizing it. Our debt on our last deal was under 2.5%. So we're borrowing at 2.5%.
For what period?
The last deal was 7 years and 4 years of interest only. So very, very good debt. And that allows us to pay immediately cash returns. So we pay 10, 11, 12% current every quarter to our investors, depending on the deal, because of that cheap debt that lets us do that. And that's what's attracting Wall Street now to this. They're figuring that out. But what we also like about what we do is not only do we make money, but we do something really good. We fix up properties. We sleep at night knowing we're giving a comfortable place to live to people who work hard and help build America. And it's clean, it's safe, and people can have pride that they live there. So that makes us feel good that we can do something good for society and make money. It's the best of all the worlds. So,
what is the demographic status of the islands?
I'm sorry?
The socio-demographic status of the people that live there.
Well, it depends on the property. C to B, it could be a big range of people. So our last deal that we bought, the rents are, it's in Denver, $1,500, $1,600 a month. It's a young professionals, mostly young professionals, and some empty nesters. That is people who, their kids left the house, they don't want a big house anymore. You sell the house, move into an apartment near the city so that you can go to the theater and go to dinner and go out with friends and not worry about a big house. So there's an example of one demographic. And in others, we have Hispanic workforce, people who are in construction mostly, and they're great tenants, by the way. They pay on time. They take care of their place. Sometimes we have an overcrowding issue, but they're very, very good tenant. And then sometimes it's just a mix. So if I go back, Jackson Creek, when we took it over, it was all it was about 60% black, African American, and the rest was Hispanic. Today, 11 months later, it's about 20% black, it's about 40% Hispanic, and it's about 40% white, white people. They're coming from in town. They can't afford those more expensive apartments. They're raising the rent so much, so now they're coming where it's more affordable. So it's kind of all mixed: young professional whites, Hispanic families, and black families in there. In Druid Hills, also we came in, it was about 60% African American and mostly workforce, but it's right near the CDC, the Centers for Disease Control, and Emory University. So in 10 months, it's now maybe 20% African American, and it's now 20% Jewish, and the rest are Asians, all getting their PhDs or they're researchers at the CDC and Emory. So there's like everybody has a doctor on their license plates. But it was, again, 1 year ago, mostly African Americans or Hispanic workers. And now it's doctors and researchers and graduate students. So it's a big change. So it's all depends on the property, how old it is, and the location.
What's the rate per square foot in these two places?
Too cheap. Oops. This is 97% occupied. 97%. We've raised the rents tremendously, but the average rent is only $600. I bought it, it was like $520. So I've raised it $80 in 10 months, and I think this is going to go to $750.
How much is it per square foot?
65 cents. Very cheap. This one, the rents are $700 now. I bought it, it was $620. So it's now $700. I think this is going to go to $900 or more. But right now I'm paying 12% current to the investors here, and that'll just keep going up. And both these loans, I used more expensive bridge debt, about 5.5% interest. So I'm going to refinance it now at 2.5%. So we're going to go from 12 to 20% because of that debt. And the rents keep going up.
And usually you buy from the investors' money?
Right. Let me talk about that. So what we do, we used to use Wall Street money. We always used to go to Lehman Brothers, to Blackstone, to all the companies you think of on Wall Street, to Goldman Sachs, and they would invest with us. And so that's what we were known for. In 2011, when we went back into this business, buying, we went to Wall Street, and they said, sorry, we don't have any funds raised, we don't have the appetite right now, we're still cleaning up our balance sheets, we can't invest in this kind of real estate. And so I was forced to go and take what we call in America my hat in hand, and I went to my friends and said, do you want to invest with me? And so I'll give you institutional returns if you invest with me. And so I invested, raised like 20 of my friends, put in $100,000 or $200,000 each, and they backed me because they knew me for 20 years. And then I did a second deal like that. And each time I thought, oh, now that I'm making so much money and I can show everyone the returns, and here's my checks, and here's the financial statements, that Wall Street would come back and fund me. And that didn't happen. So by accident, we became our own capital company. And now we've raised $150 million from people like you.
And no mortgages?
No, they're mortgages.
No?
Yeah, that we get debt, and so it's like 70% loan. You get a loan for about, if we buy a property for $10 million, we borrow 7 from the bank at 2.5% or 3% or 4%, depending on when or what kind of property. And then we would raise money from regular folks to fill in the 30% of the equity. Thank you very much, everyone. Thank you for hosting me and letting me come. And thank you for coming out.